Welcome back to another episode of That Backyard Property Pod. We are here today for another mini episode. Last week when you tuned in, we touched on all things trust lending and the changes in the industry led by Macquarie. This week, we are tackling all things inflation. On Melbourne Cup Day, hopefully you gambled responsibly and you got up on the horses. If you didn't, unlucky. So, Reserve Bank met last week and they kept interest rates on hold. There was strong suggestions throughout the year that on Melbourne Cup Day, interest rates would be cut for the third time this year, and boy, would that have been a great Chrissy present. Unfortunately, it was not the case. Why? Because of the recent inflation data. The inflation data, if we're pulling the hood off this, we're saying inflation is the cost of goods. So the increasing cost of goods in a basket. So they look at all things across the board and they say, how much are these increasing? No doubt you're feeling this on the back of your grocery bill or your dinner bill or whatever it might be. The cost of living has continued to increase. And this is showing in the data. So in September quarter, the trimmed inflation data was 1%. 1% for the quarter. That extrapolates out to 4% for the year, which is so far above their expectations and also the range in which they want the inflation to be held in. Let's look at what had changed. If we're looking at housing, was up 5.6%. That's massive. Food and beverages up 3.1%. Alcohol and tobacco, 5.5% increase. These are massive figures. And no doubt I'm guilty of it. We've had a few nights out. We've bought some nice red wine here and there. And no doubt everyone else in the country seems to be doing exactly the same thing. As we lead into Christmas, the costs of goods have continued to rise and people are still spending money on it. Domestic travel, also a massive contributor to this inflation data. On the flip side, unemployment rate also increased, which is not a good thing. So we've got inflation increasing well beyond what the RBA was hoping and unemployment increasing beyond what the RBA was hoping as well. Two negatives. Unemployment has increased to 4.5% from 4.3%. That steady increase is not what we're wanting in this country. So I think the numbers were 34,000 more unemployed people in that period of time. These are large numbers and there's big impacts on this. So if we're going right back to home lending, and if you have an existing loan or you're looking at taking out an existing loan, we will not see a rate cut in the foreseeable future. I was of the opinion that we would see one either on Melbourne Cup Day or the first meeting next year. That is looking so unlikely. And if there's another increase in inflation in the first quarter next year, the chat around interest rates increasing will start to get louder. Now, what can we do about this? When we're looking at home lending, you've got the ability to have a variable interest rate, which fluctuates, or we have a fixed interest rate, generally fixing between 1 to 5 years. Most people fix around that 2-year bracket because that's usually the cheapest. If you have an existing home loan, it might be worth considering, depending on your current rate, whether fixing becomes an option, because a lot of people do not like uncertainty. What does fixed rates do? It removes uncertainty. At the moment, fixed rates sitting or below 5%, so sitting around 4.89, 4.99%. Most variable rates are sitting around 5.3, 5.4%. So the banks are saying they're expecting at least 1.5 to 2 rate cuts in the next 12 to 24 months. The thing around fixing is once it's fixed, you're then paying that lower rate as soon as that happens. For me, I hadn't fixed any of our clients' rates for a long time, And over the last 2 months, we've started doing that. And what you can do is you can split the loan. So you can have a portion variable. So you still have the flexibility of paying extra off the loan and having an offset account attached to it, whilst having a fixed portion that is a certainty. That is exactly the repayments and interest rate you'll be paying for that 1, 2, or 3 year period. If you have any questions around this, I'm more than happy to tackle this because the inflation data is a constantly changing beast, as is the unemployment rate. The RBA will be they'll be so focused on the first reporting quarter next year. So we'll probably get that around March. So come March, we'll be back in on the studio tackling this because it will give us a really clear indication as to what we can expect in 2026. It's crazy. We're already in November. Christmas comes around. That's almost a write-off, and so is the start of January, and then we're back in February. The community we are building is growing, and it is amazing to see. If you think any of your friends or family would benefit from any of our episodes, especially around inflation or trust lending last week, and please share it with them. And please, if you could, like, subscribe. I know everyone that does a podcast wants you to do this, and it really, really helps grow the channel and grow the community. Thanks again for listening. Have an amazing weekend. I hope you enjoyed the episode on Tuesday last week. We'll have another amazing guest come out next Tuesday. Until then, let's do it.